Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, with the outlook for U.S. stocks in the new year to be dicey at best, at least for the first half of the year, if you had $100,000 in fresh cash to invest for all of 2009, how would you do it? That's the question that we put to our roundtable panel members this time around. Steve Reitmeister, our editor-at-large at Zacks.com, Charles Rotblut, our senior market analyst, and Kevin Matris, top stock screener here at Zacks. And back in part one, this is part two of a three-part roundtable, by the way, we heard from Steve. So this time we're going to lead with Charles. And a lot of investment managers out there are recommending defensive plays for the stock investors for the new year. What do you think?
I actually agree with it, especially for the first half of the year. And to start off, I want to talk about the fixed income markets. Right now, as we end 2008, we're seeing a massive flight to quality. We're really seeing yields on treasuries dip substantially. And I think one of the things that's not really being said, if you're an investor who depends on having income, particularly bond yield income, really the smartest move right now is to go to TIPS, which are really inflation-adjusted treasuries. You can't really control what treasuries you're going to do. It doesn't make sense to lock up your money for 10 years or long on a treasury note right now. We know over the short term, deflation is a massive fight that's really going to hurt returns across the board over the next 6, possibly 9 months, depending on how long it takes to get the economy moving back in the right direction. Mm-hmm. Therefore, investors really need to think about, A, not tying up their money in bonds for a long term right now because you're going to get really bad interest rates, but also realize that once we move out of this recession, we're going to see high inflation, so you need to adjust for it. I think for people investing in stocks, they need to think the same way. Over the short term, we're going to have some bad returns, probably have a trading range at best, possibly new lows in the markets. I think we could actually see a substantial drop between now and possibly the summer. But I think for investors looking at it, they really need to approach the market really in two things. A, they need to go defensive. They need to really think about what do people need, what were companies going to spend on. And if you look around, you got to think in terms of things like food, particularly agriculture. We're going to continue to obviously eat. The new agriculture secretary that Obama picked, very pro-ethanol, so we should see a boost in the agricultural sector. Got to think in terms of frugality. Look at fast food companies. McDonald's, our analyst who covers fast food stocks, really likes Burger King. Yum Brands is going to redo the Taco Bell menu this year, so you can look at people spending less there. Mm-hmm. Conversely, I think when people will really get themselves burned is when they try to actually go back to companies saying, oh, this company's being down, and not really asking what happened to this company before the recession hit. Look at a company like Citigroup. A lot of complaints during 2006, 2007. Company's too big. It's not managed correctly. I think when you look at the financial sector, it's not an area I would take a chance on. You take a look at semiconductors, had a lot of pricing pressures before this recession hit. So I think investors, they need to look at companies that are doing well before the recession hit, have a reason for people to keep spending on them over the short term. I think it's your defensive play. But I think when you look in the second half of the year, possibly 2010, the timing's uncertain. Then you got to start thinking, what if inflation kicks in? And I think at that point you need to start looking at commodities, perhaps use ETFs. I happen to actually like the oil and gas pipelines right now, pay a very high dividend yield, looking at 8, 9, 10%. Again, though, people are going to continue use gasoline or continue using natural gas, continue using oil. There's a reason to have those pipelines and a reason for them to continue to generate cash.
Yeah, inflation is still a wild card out there, and there's arguments on both sides of that. But in the defensive group, what about healthcare? What about consumer staples?
I like both. I do like healthcare. I think biotech could actually do well, especially once we start getting the rebound. The reason I like healthcare, again, it's a necessity. It's not going to be impacted by the economy. There is a lot of talk about Obama wanting to actually change the way we provide healthcare. You combine that with we're going to see a decrease in employment throughout next year, higher unemployment rate, lower non-farm payrolls. I think that doesn't bode well for the health insurers. But I think you look at the drug companies, I think they can do very well. Consumer staples, again, what do people need? Obviously, cereal, toilet paper, paper bags, trash bags, all that type of stuff I do like. But I think, again, people need to be careful because Procter & Gamble recently cut the revenue guidance for this year. So you really need to pay attention to what these companies are trading in terms of valuations, what's going on in their earnings estimates, and really what their business momentum's like. It's definitely going to continue to be a stock picker's market, but I think it's also going to be a sector picker's market where you need to be in the right sectors and avoid the ones that are more risky or have a reason not to recover over the short term.
What about financials and technology?
Financials I would avoid, and I think Mitch Zacks has said this before, and I agree with him. I think people will be better off being late to the party than being early. That said, people looking to play financials probably look at the life insurers first, property and casualty insurers first, and the banks second. But even look at the banks. Look at who was doing well before we had this huge credit crunch, and avoid the companies that weren't doing well. And again, I'll hammer on Citigroup because I see so many people saying, "Oh, buy Citigroup; it's cheap." Well, Citigroup had a lot of problems beforehand, and there's a lot of other financial companies that struggled beforehand too. So I think you really need to be picky if you're going to take a chance on it. But I think it's really second half of the year at earliest because we've seen estimates being cut for 2009 throughout 2008, and as we head into 2009, we're continuing to see those earnings estimates cut.
What do you guys think? It's hard to know where exactly to invest when bear markets put in only a tentative bottom, as we've been seeing right along.
Well, I mean, history serves as a very good guide. I think Charles gave a very good picture of what the defensive portion of the portfolio looks like on the way down, and the consumer staples and healthcare and things of that nature. I think that was an excellent call. And then, but again, it's really, that's the easy part right now. The tough part is trying to say when is it time to switch over and go to the long side or go on the more aggressive side. And as far as the financials, I agree. It's one right. I'd just rather miss the party, maybe entirely, because with our model, the way we look at things, we're just trying to get the odds in our favor. We need the earnings estimates to be going up, and no time soon will the earnings estimates be going up for the financial firms. I'd be staying away from that. Technology, great great recovery play. Okay, and so like the semiconductors are a terrible one on the way down. On the way up, they're one of the things that usually lead the pack. And so that's where you got to almost switch almost everything you said on the way down. You got to now switch it out and go more aggressive on the way up to profit.
But one thing I disagree with, semiconductors had a lot of pricing problems, a lot of inventory problems, and I think for technology, you may want to look really at some more companies that outside the technology sector. Looking at IBM, gets a lot of its revenues overseas, so it'll benefit from a worldwide rebound. I think Apple with its consumer products. You may want to take a look even at Google. They're moving heavily into mobile phones, and they can gain traction there. So I do think there's areas in the internet and technology sector that play. I'm not so high on semiconductors, more so towards software, services providers, those type of companies.
Kevin, what do you think? Was he just looking over your shoulder when you were screening one day? Or
let me tell you, Steve had mentioned it, Charles had mentioned it. I'm going to talk about it a little bit as well. But yeah, everybody's talking about this expected economic recovery in the second half of 2009. But if everybody can think back, we were supposed to have the economic recovery in the second half of 2008. So yeah, it's this shell game. Where is this economic recovery going to be? Is it going to be pushed out to 2010 or even further? So a lot of it is going to depend on when we finally see the economy stop collapsing and we finally see the economy starting to get a little bit better, and that's the big secret.
All right, just for the record, I didn't say second half 2009. I said 2010 recovery.
Oh, right. But again, everybody's looking for this later thing. It keeps getting pushed out.
The rest
so
of
again,
the street dirty.
Stand corrected. Steve, 2010 economic recovery.
But I think the big thing, once we do start seeing the economy recover, long term we're going to have inflationary problems, and that's why I think long-term commodities is a really good place for people to be in.
So as you look at sectors to get interested in, would you stick with just the number one or two players in those sectors as far as stocks are concerned?
I think you got to look at who's done well traditionally before it and really focus on those guys. I mean, I think it's really, especially when the recovery starts, you really shouldn't be focusing on the guys who are just being down they're being down. I think you got to look at the people who have a reason to actually benefit from the rebound. And I think in some cases you'll see some smaller players that have niches and have successfully exploited those niches before do well. And I think you'll see some larger players use their cash balances and use some of the valuations to buy up some of those companies. And I think in some instances you could look at a smaller player that's done well before the recession kicked in that actually controls its niche really well and actually not only give you a boost from the economic recovery, but actually might be an attractive takeover target. But I think people need to be careful as to which ones they play.
Do you own any of that blur of stocks that you put past us?
No, I do not.
There's about 100 stocks there.
There you have another game plan for investing in the new year. With everybody here at the roundtable, I'm Terry Ruffalo.